Hi, Rahul Magan here as the Chief Executive Officer of Treasury Consulting LLP, and this time we would be covering a topic which is fundamental review of trading book potential pitfalls. As you very well understand that 2018 would be a wonderful year for a treasury function. A lot of changes are happening. A few days ago, like a couple of days ago, was the very first day of the implementation of the MiFID. Although on paper the MiFID was applicable from 3rd January 2018. I was looking at the Bloomberg TV and there was a lot of discussion which was happening about the MiFID, and then I decided that let's make a video on the FRTB also, which is fundamental review of the trading book, which is getting applicable in 2019. This year we have predominantly a lot of new things which we are coming, like PST2 is coming, MiFID is already there, but the potential pitfall with the MiFID is that all the big hedge funds, they not yet entered into MiFID, and there are many multilateral trading facilities, many organized trading facilities, and many systematic internalizers and many people in the regulated market, those who not yet entered in the MiFID second. And last but not the least, the hedge funds. Basically, if you say 1,000 corporates on one side, and the total flow of one hedge fund is on the another side, they are also not here in MiFID second. So the time would tell that exactly how the things would be moving, but in an overall space, that regulation acceptance is very reluctant. Like corporates, bank, financial institution, hedge funds, they are not they are very reluctant as far as the acceptance of regulation is concerned, because a lot of things you have to change it out. And this video would be talking about FRTB, which is fundamental review of the trading book. Yes, we do appreciate that basically in the 10-15 minutes of this video, we won't be able to cover each and everything about the fundamental review of the trading book, but of course we'll try and touch a very important point. Well, after Basel III, the Bank for International Settlement, which is nothing but the regulator of regulators, basically the central bank of central banks, they came up with a regulation which will make sure that the banks would have a sufficient capital as far as their trading book is concerned. Of course, this video do not applicable to any banks in India, and we should also understand that 3rd January 2019 is the implementation date of FRTB, Fundamental Review of Trading Book. Although on paper it is 3rd January 2019, but practically speaking it has not yet been agreed. So like MiFID second was proposed in 2016, then somehow it went to 2017, and now finally implemented 3rd January 2018. Similarly, on the paper, fundamental review of the trading book is being on paper to be come out on 3rd January 2019. Only the time would be telling exactly how and in which shape it would be coming, whether all the regulations would come or not. The biggest problem as far as the FRTB is concerned for all financial institutions are practically three. One is operational problems, computational problems, and organizational problems. Operational problems is problem pertaining to the front and the middle office of a particular bank. Because if you talk about the big banks like Goldman Sachs, JP Morgan, Standard Chartered, UBS, they are predominantly working 24/7. The sun will never set for them. So they're working 24/7, and what exactly it happens is that they don't have a single middle office, they have a set of middle offices which works for them. So if you talk about Goldman Sachs, they are practically working across the globe. So they cannot rely on the one middle office. So they have multiple middle office, which is nothing but an operational challenge. One thing which is coming up in FRTB, as far as the operational challenge is concerned, sitting today, if you ask this question that what are the three offices which we have in a treasury function across the globe, the standard answer would be front office, middle office, and back office. But if you would have read the reports of fundamental review of the trading book, you would have get to know that FRTB is asking, not in a silent mode, in an upfront mode. They are asking about middle office to be divided into two parts. One is the trading middle office, and one is the non-trading middle office. Although the differentiation factor between trading middle office and a non-trading middle office is not clearly mentioned anywhere as far as the Google reports are concerned, the bank reports are concerned. But if you look out the reports of fundamental review of the trading book and the latest survey which has been done by a UK body, it's being pretty clear that they want two kind of middle office, which is trading and which is non-trading. Now the operational problem is the big banks like Goldman Sachs, JP Morgan Chase, Standard Chartered, UBS, Deutsche, Barclays and all, they are too big that if they start bifurcating their middle office into two parts, it would seriously be a big mess for them. So what exactly they would be doing, it would be a mess for them. So what exactly they would be doing is that only the time would be telling. There are a lot of emails which are also coming from banking side to the regulators within banks and asking the regulator that we should not have that, so on and so forth. This is the first operational challenge. Second and very important is the computational challenge. If you ask me to rate out of 10, I would be giving 7 to computational, 2 to operational and 1 to organizational. Because organizational problems are everywhere. People are reluctant to change. They really do not want it to change. They want whatever is going on should continue to move on. Plus minus 5% is fine. Why you wanted to change? So such kind of operational problem is always here. But the biggest question is the computational problem. And fundamental review of the trading book. Although again I agree that in the 10 to 15 minutes we cannot cover everything about the fundamental review of the trading book. But these are the biggest things which FRTB is asking. Number one is FRTB saying, boss, every bank is managing two books. You appreciate it, you don't appreciate it, which is a trading book and which is a bank book. Unfortunately, I'm not saying unfortunately, you take this as a fortunately or unfortunately, I don't know. But before 2008, even today, very limited amount of banks. Before 2008, count was very big. And now banks are managing also, the bank used to manage, which is prop book, which is proprietary trading. But now, not all the banks are doing the prop book, and the hard reality of the life is that, more or less, the practical thing is that the bank have merged the prop books, proprietary book with the trading book. Well, there is no standard report which is available here. You know, I was head of treasury, we understand banks, we know the banks, but more or less what they did, they have merged the prop book with the trading book. That is why if you read the critical research report on FRTB, you would have get to know that they are silently discussing about a merger between a proprietary book and a trading book, which is again a concern for FRTB. But the unfortunate fact is that this not being addressed by the not being addressed by the BIS, which is Bank for International Settlement. Although there are a lot of, I would say the reports and everything which is there in the media, but very limited amount of text is targeting a possible merger or already a merger between a trading book and a prop book. The biggest problem with the trading and the banking book is that what banks are doing till now, banks used to do in 2008, and unfortunately even in 2008 when the major focus was on the OTD stands for originate to distribution, nobody talked about that. Nobody wanted to talk about that. But FRTB this time wanted to talk about that. The biggest issue as far as the trading and the banking book is the move of the illiquid asset. And this is where the prop comes. Actually what banks are doing, there are a lot of, say if you are taking a position in any asset, nobody in this world can tell you that whether this asset would continue to be liquid or it will not liquid and so on and so forth. But what actually it happened is that over the period if the asset turn out to be illiquid, I'm not using illiquid, I'm saying might be defaulted or might be a stress asset, both, maybe all three, right? Then what banks are generally doing, banks will transfer this from a liquid book to the banking book. From a trading book to a banking book. And you very well understand that after 2008, you just name the bank. I don't want to name any bank, but you just name a bank and they had a huge fine on their head. And in fact, today also, without quoting the name of the bank, there are so many banks which we have, those who are still facing a fines. So, I would say that this is something which is a serious concern. The bank should have looked at that, right? To be, in my personal opinion, right? The move of the illiquid asset from a banking book to a trading book is something which is an issue and something which should have been addressed very carefully. Fundamental review of the trading book is putting a bar on that. FRTB is clearly saying that once applicable, and hopefully this law will get applicable. I strongly doubt. My reluctance is there that this will not get applicable. The reason being, you just name the bank without quoting the name of the bank. Everybody is doing that. So I doubt that even they would be able to allow regulators to stop it, but only the time would be telling. But this is one of the biggest computational problem which fundamental review of the trading book would be facing. And of course, valuation is always an issue. Another is moving above the approach. So basically, fundamental review of the trading book is saying that we have to move from we have to move from internal rating based approach to sensitivity based approach. Because what exactly is happening right now, if you ask any bank, I hope you must have heard about DFAST, which is Dodd-Frank Annual Stress Testing, which is one of the RegTech also, which we are covering in our fixed income platform. In DFAST, every bank is supposed to have an annual stress testing being conducting by Federal Reserve, and of course there are a lot of parameters on which bank would be positioned. But this is something which a regulator is doing. What a bank is doing. Every bank in this world is currently following, as far as the Basel III is concerned, every bank in this world is following the internal models approach. Now, all the internal models which the bank have developed is basically, from a regulator standpoint, this always has an issue. The reason being quite simple. 2008, the banks were having internal models. 2012, banks were having internal models. 2014-15, banks were having their internal models. But irrespective of these so-called internal models, we saw a great crisis in the books of all the banks. And without quoting the name of the bank, you have Citibank, which has moved to even $3 per share. American Insurance, AIG, American Insurance Group went to, I think, less than $1 before within 2008. So fundamental review of the trading book is saying you have to move from internal rating based approach to sensitivity based approach. There are a lot of things which we should discuss about sensitivity based approach, but the time is pretty limited and we cannot cover everything in basically in 10 to 15 minutes video. And very important thing which is close to my heart is the VAR, value at risk, and the various types of VAR like stressed VAR, cash flow at risk, expected cash flow at risk, and there are multiple kind of VAR. It's gone. It is history now. Unfortunately, even today there are many Western business schools which are still teaching the value at risk, and of course in every business schools in India the value at risk is being taught. But as far as the fundamental review of the trading book is concerned, value at risk soon be a history, because value at risk would be replaced by a latest technique which is expected shortfall. I'm not saying that expected shortfall is something which is very good technique. I'm not saying it do not have any pitfalls. I'm not saying that it's something which is immaculate, something which is perfectly fine. But yes, I love to say that expected shortfall approach, which is ES approach, is quite better than as far as the value at risk is concerned. But of course, when we'll have a real implementation of the ES by the banks, I'm sure that the quants which are sitting in the banks would have something in their mind, so that the implication of the ES, the delta, which is the difference between ES and VAR, will surely be not coming in the P&L. I'm fully sure about that, but only the time would tell. And very important, the second last thing, which is something, FRTB wanted to move away from annual stress testing. They wanted to add something which is trading analytics, including capital modeling. The valuation approach of trading analytics, the capital modeling, is something not being discussed in an open space in the research papers. But as far as the trading analytics is concerned, my personal opinion is that it would be better than what we have in MiFID II. Of course, some or other part of stress test would surely be there, like we have DFAST. But I'm pretty happy that a fundamental review of the trading book is moving from stress testing to trading analytics, which would surely be including capital modeling. This is something which is a wonderful thing, and only the time would be telling how effective it would be and how better the bank would implement that. But I will see that it is a good thing. Last thing, which is a non-modelable risk factor, NMRF, non-modelable risk factor. In a stress testing, the biggest problem with the stress testing and the trading analytics, the difference, if I would say, is that in a stress testing, what exactly it's happening, that the non-modelable risk factor are ignored. Something which cannot be modeled, ignored. But in fundamental review of the trading book, a relevant bank who is maintaining a trading book, and all the banks maintain a trading book, they have to clearly tell it about. They have to tell it about, boss, these all the non-modelable risk factor, and this is the capital charge which we are maintaining in the books pertaining to that. This is something I'm saying that this is a pretty good thing, pretty damn thing, in the sense like, if we talk about today the stress testing, then nowhere you look at any stress test like DFAST, the stress test being conducted by the European Central Bank, or you take any stress test, you would have get to know that nowhere they are talking about non-modelable risk factor, or even if they talk about that, they talk about only a fraction part of that. But what is a beautiful thing which is going to get happen once the non-modelable risk, once you have fundamental review of the trading books would be coming, is that all the non-modelable risk factor to be mentioned separately, and the bank have to tell in writing and also the computation that this is the capital charge which they are maintaining pertaining to these factor, which is something which is not seen with the stress testing. And last, and a very important thing, which is something which is currently being targeted by all the banks, but not all the banks are doing all of that, which is the valuation adjustment. And the latest in the valuation adjustment is LVA, which is liquidity valuation adjustment. The total 7 brothers is capital valuation adjustment, liquidity valuation adjustment, debit valuation adjustment, funding valuation adjustment, margin valuation adjustment, capital valuation adjustment, and collateralized valuation adjustment. This is something which we would like to discuss. My personal opinion, this fundamental review of the trading book is a wonderful technique, but at the same time, as a treasury head and now managing the treasury of my own company, I strongly request the regulator that banks should get the appropriate time to change their system. They are just now, you can say by hook or by crook, somehow they are living with MiFID II, and who knows, MiFID III will come. Who knows? Nobody knows. Maybe 1 year down the line, 2 years down the line, MiFID III would have come, or maybe we would have a drastic change in the MiFID II. Banks should get sufficient time. At the same time, from a bank standpoint, I would like to request all the bank that whatever systems you are running is something which are getting obsolete. We are into an era when a huge volatility is there in the market. We cannot take this thing as granted. Yes, I do appreciate that. There are a lot of things which are coming, like on 28th May 2018, GDPR, which is Global Data Prevention Regulation. This is again coming. So a lot of action which is happening in the banking sector. And hopefully 2018 would be a wonderful year. At the end, I would like to remind you that our fixed income platform is just round the corner. Not more than 10 days of effort is required. And we are covering a dedicated desk of RegTech, regulatory technology, wherein we are covering everything like that. In fact, one of the sliders which we have made in these sliders, we are covering a RegTech in an exact detail. I hereby wish you all the best, because a lot of action is going to happen in the next 3 years, 18, 19 and 20 in the banking sector. A major overhaul is around the corner, and a lot of business opportunities which are on the way. We would like to thank you very much, and in case you like this video, please put a like button and also put a comment, a feedback about the video on the YouTube channel. My number, though known most of the people, but still, in case you want to talk, my number is 9899242978, while my Skype ID is Rahul5327. My email is rahul.magan@treasuryconsulting.in. My currently website is www.treasuryconsulting.in. Our upcoming fixed income platform would be www.fixedincome.global, and the fixed income KPO number is 91, which is an Indian code 1140199774, 911140199774. Thank you and have a wonderful time ahead.